Good afternoon, everybody, and welcome to today's reverse mortgage webinar. I'm Cindy Bishop with Cindy Bishop Worldwide, and it's a pleasure to introduce our esteemed master instructor for today, Kelly Catalinus. Kelly is a seasoned mortgage loan officer with over 3 decades of experience. Kelly has not only excelled in her career, but has also become a leading lender and branch manager. Her expertise extends to training agents and lenders, enhancing production and cultivating lead generation. And this is a good example. Not only is it a great program, but it's really good for agents to understand it. In recognition of her outstanding contributions, Kelly has been honored to receive the Lifetime Achievement Award by the Washingtonian Magazine. Additionally, she has received the 5-Star Professional Award for the fifth straight year. I was thinking about the way I have fourth here, but I think it's the fifth
It's
straight
the
year,
fifth, yeah.
which was bestowed upon only 3 out of 4,600 individuals in the Washington, D.C. area in 2025. These are just some of the many professional awards and accolades that Kelly has received. What truly sets Kelly apart is the trust and admiration she's earned from her clients and agents, with most of her business coming from referrals. And I will tell you, it's because of her steadiness and her attention to detail and her unwavering calmness. Jeez. Yeah, I mean, it's just amazing. And that's why people just love her. Very steady, very good at what she does. So without further ado, join me in welcoming Kelly.
Thank you so much. This is one of my favorite classes to teach. I will tell you, I turned 62 on Sunday. So I am now in the range to be happy to turn 62. This is a great tool to use with your senior community and those that have high equity in their property. So we're going to walk through the reverse mortgage program. We'll do an introduction to reverse mortgages, describe what they are, talk a little bit about the loan qualifications and options because you definitely qualify for this loan differently than any loan you may have applied for yourself. How can you use it? There's multiple ways to use a reverse mortgage in your financial planning for your retirement. And then what's a maturity event? Okay, what do we call loan maturity when it comes to a reverse mortgage? And why Fairway is just a little bit about why we are one of the top lenders for reverse mortgages across the country. So let's just dig in. Um, as we go through, we always say when people hear the term reverse mortgage, we really should change it to retirement mortgage, right? What's your opinion? We have people and our realtors and borrowers say, oh, they're great. We've heard some great things about them, or they're living in the past from when reverse mortgages might have first rolled out, when there were a lot less securities and protections for the borrowers in them. And they'll say, I've heard some bad things, but I'm here to learn a little bit more. And that's okay. All right. So we want to kind of address where we are today with reverse mortgages and how you can use them in your retirement planning. Wade Pfau is a PhD who's done extensive writing about using reverse mortgages strategically in order to extend your retirement nest eggs. Okay. Um, his point is everybody is afraid they're going to run out of money in retirement, right? Nobody knows what their health is going to be like as they age, right? And what they might have to face. So there's a lot of good books by Dr. Pfau explaining in greater detail than I'm going to cover today how you can use this very strategically in your overall financial plan. And we'll touch on it. I think that'll resonate as we go through. So again, if you're 62 or older, are you concerned about? And these are questions not only you might ask yourself, but if you're serving the senior community in your real estate business, these are questions that could come up, especially when you get a client who wants to sell their current home and possibly buy a downsized or right-sized home in cash. Using all of that cash to do so might not be the most prudent way to use their funds if you consider how you can use this strategically to extend some of their retirement earnings. Okay. So if they're 62 and older, they're concerned about market volatility, inflation, right? That they're now going to be on a fixed income, but they can pretty much assume that the cost of goods and services are going to increase over time. Their living expenses might increase over time. They're worried about outliving their savings in retirement. How can they make monthly mortgage payments in retirement? And, is the only concept that they know of is to reduce their nest egg in order to live in the house that they would like to remain in for the foreseeable future. Not being able to continue to live in their home, meaning it's not physically appropriate for any medical conditions that might be coming their way. Too many steps. Maybe I need wheelchair access. I need ramps, whatever. So all of these things concern people as they age, right? A reverse mortgage could be a solution to some of those concerns. So today I'm going to focus on the reverse mortgage that is the most used reverse mortgage across the country, and that is the FHA home equity conversion mortgage. We'll define that in the next slide. But the reason for that is under FHA through the Federal Housing Authority, it's the reverse mortgage that has the most protections for the borrower as well as the heirs to that property. So we'll go through that. But in general, a reverse mortgage is a home loan exclusively for older adults. The one we're talking about today is for those age 62 and older. There are some proprietary reverse mortgages that are available to those age 55 and higher. Okay, so there's a couple of different ones out there. It converts a percentage of the home equity into tax-free cash. You are not required to make any principal and interest payments on this loan. You have to continue to make your real estate property tax payments, your homeowner's insurance. If you have an HOA or condo fee, you have to continue to make those payments on your own. There are no escrows set up on a reverse mortgage. Okay, no escrows. So the home equity conversion mortgage, or HECM, as I mentioned, is the most used reverse mortgage in the United States. About 95% of all reverse mortgages will use this program. It was launched in '89, but since then has had numerous consumer protections added to the program to protect the homeowner and the heirs to the property. It's the only reverse mortgage that has mortgage insurance included in it through the Federal Housing Administration. So MIP is a term you might be familiar with. That is in place on this loan, and we'll explain why as we go through. And again, age 62 or older is the requirement for this home loan. So people will always say, well, aren't these just for people that are in a last resort situation, meaning their assets have been depleted, they can no longer afford their current forward mortgage or regular mortgage, but they're sitting on a property with extensive equity. It's a loan of last resort. Well, no, it's not just for a loan of last resort, okay? There's many reasons to get a reverse mortgage. The first obviously would be need, right? People don't want to lose their home. Maybe they've lost a loved one, monthly pension or Social Security is reduced. How do we get to stay in the home that we've lived in our entire life? Okay. So you definitely can use a reverse to address a current need, or if a medical situation has changed, they want to stay in their home, they're able to stay in their home, but the home has to have some adjustments made to it to accommodate them staying there, or maybe they need some in-home care. Okay. Some people use reverse mortgages for lifestyle enhancement. I had a woman call me yesterday saying, my husband and I don't have anyone to leave our home to. We decided a long time ago that we were going to spend our equity for a lifestyle enhancement. She already had a reverse mortgage and was asking about refinancing it, right, to access more cash, right? So she understood the benefits to her and her spouse for having a reverse mortgage and what they wanted their life to look like. Okay. Some people use a reverse mortgage to pay for things, that are not in their typical pension budget. They set up a line of credit on a reverse. They don't make any payments on it, but they tap into it to take that big trip each year or to give a gift to their grandchildren. Maybe they want to help somebody buy a house and give a gift or whatever, and not deplete those assets that are working for them in their retirement with their financial planner. So they can use it in a different way. And in the case of my mother, who I always talk about during these classes, is we set up a reverse mortgage to increase her cash flow each month after my father passed away, right? So, because they only had Social Security, that got reduced upon his death. She needed additional monies to allow her to live in her property and sustain a life that she needed. Okay. So you can use it to maximize cash flow monthly. Some people use it to reduce taxes, and I'm not a tax accountant. I'm only going to say that monies you take out of your home by virtue of a reverse mortgage is not income. You are not paying tax on that distribution. It is a loan. You are loaning it out of your house to yourself. So any money you receive out of the reverse mortgage is not a taxable event to you. Okay. And we'll explain how that might work with those that are commission-based earners in a little bit. Okay. All right, so some pros and cons. It's the pros. It's a source of additional cash flow per month, or can be. There's no monthly principal and interest payments that have to be made on this loan. You still have to make your taxes and insurance and maintain the home, right? You can't let the home fall apart. And it's a non-recourse loan. And what does non-recourse mean? Non-recourse means that the home, regardless of the balance on the loan to the value of the home, will always satisfy the loan. Okay, example, you owe 450,000 on the reverse. The home's current market value is 400. The last living person has passed away or moved out of the property permanently. They could give that home up, and there is no gap that the borrower or the heirs would be responsible for. The home will always satisfy the mortgage, even if the home is underwater. Okay, so huge benefit. All right. Cons, of course, there's a minimum age requirement. It's not a product that can be offered to all individuals. It's based on actuarial tables and high equity positions in a property. Negative amortization occurs, right? Interest and fees each month chip away at the home equity over time. And it's got to be your primary residence. You cannot offer a reverse mortgage on a second home or investment property. Okay. All right, so some reverse mortgage myths. We're going to debunk them here. The bank will own your home. Absolutely false. Just like on your home loan right now, you're in title, you remain in title on a reverse. There's nothing that changes from how you might have had a mortgage before to how you will have a mortgage in the future on a reverse. You also can take title to the property in the name of your trust. So if you have set up a revocable trust, not irrevocable, a revocable trust, we can get that trust reviewed and you can take title in the name of a trust. Okay. I just closed one this month on a woman in a condo who happened to have an FHA approved condo she lived in, and that note was in the name of her trust, and we closed it in the name of her trust. We just have to get the trust reviewed. My heirs will be stuck with a big bill. So again, no, you or your heirs will never owe more than the value of the home after the loan matures. So regardless of if you have a higher mortgage than what the home is valued at, the house will always satisfy the note. Okay. You have to own your home free and clear in order to qualify for a reverse mortgage. Absolutely not. You have to have a high equity position. Okay. In general, I would say 60% equity in the home. If you were converting a loan on a forward basis to a reverse loan, you're limited typically to about 40% of the value of the home. Okay, so high equity position, because again, it's being based off of actuarial tables, and that balance is going to climb over time. Okay, so it's all based on, age and value of the home primarily. So we'll talk about how we qualify you. Age 62 or older for the HECM, you've got to be the homeowner. Again, significant equity or own the property outright. It's your primary residence. You have to meet minimum credit and income requirements. So what do I mean by that? Okay. Think FHA loans. All right. You've got to have minimum credit scores for an FHA loan. Typically for reverse mortgages, they want to look at how you've made your mortgage payment and your taxes and insurance payments over the most recent 24 months. No late payments. And they're also looking at your credit report from the standpoint of revolving accounts or installment debts, typically no more than 2 times 30 days late in the most recent 12 months. Okay, so we're not qualifying you on income, but we are qualifying you on how do you make your payments. Because the biggest fear on reverse mortgages is you set up a reverse mortgage, you don't pay your principal and interest each month as a benefit of the reverse mortgage, and then you stop making your taxes and insurance payments and the house goes into default. Right? That could happen to anybody who stops making their property tax payments, right? They could foreclose on the property. So there's a concern there when looking at the credit report for that perspective only, pretty much. And then also that we have enough left for minimum family subsistence when we qualify you, right? Do we have enough left after your monthly obligations that you're eligible for the reverse? Eligible property types are single family homes, 2 to 4 unit properties as long as you occupy one of the units, townhomes, condos that are FHA approved. Some condos are not FHA approved, and we may be in a situation where we're able to get a single unit approval. We have a team here at Fairway who can look at that and see if we can get a single unit approval in order to offer the reverse in there. Planned unit developments, townhomes with HOAs, modular homes, and manufactured homes that do meet FHA requirements. So a broad array of properties that are eligible. How much home equity do you need? Again, it'll say roughly or at least 50% home equity. Let's talk about that because there are charts and we're going to go through that. But the better the interest rates, the less the home equity needed. So right now, I would say you need about 60% home equity. If rates continue to improve and Fed continues to cut rates, that will help us because think like your regular home equity line, right? It's attached to the prime rate. You're looking at these interest rates monthly if you had a regular home equity line, or maybe you have a credit card that's attached to the prime rate. The HECM is attached to the same index. So if the Fed funds rates continue to drop, that's going to expand the borrowing opportunity for the buyer, right? So you might not need 60% equity anymore. Maybe you only need 55% equity or 50% based on your age and the actuarial tables. But we do have some people that if they're short on funds, to go to settlement on a reverse loan, they can bring some cash to settlement in order to do that. Okay. I mean, ideally, we want our reverse set up so that the borrower is not bringing cash to settlement in order to do the loan. But we do have cases where they don't qualify exactly for the amount of equity that they need, and they can bring cash to settlement if needed. So how much money can you get with a reverse loan? And these numbers will probably be changing because right now is the time of year where Fannie Mae and Freddie Mac start evaluating the conforming loan limits, and then shortly thereafter, FHA changes suit. But it depends on the age of the youngest borrower or the non-borrowing spouse is how that's calculated. So of two borrowers, let's say age 65 and 68, we would be looking at the 65-year-old for setting the amount of the loan, okay? The interest rate, as I mentioned, helps determine how much the loan amount will be. But the one key thing here that is unique to this program is the HECM treats the maximum loan limit as the limit across all 50 states. So if you thought about FHA lending, we're in a high cost area in Northern Virginia, right? So the high loan limit in Northern Virginia for an FHA loan is 1,209,750. What the HECM has said is we don't care about high cost areas. We're not delineating across states and counties. We're saying that nationally, our limit is going to be 1,209,750. I actually had a financial planner contact me and say, I have a client whose home is worth about $3 million. He owes about 700,000. He wants to retire. He's thinking about a reverse mortgage, okay, on his property because he knows he can get this higher loan limit on a reverse and wants to extinguish the principal and interest payments associated with the remaining loan on that property to advance his timetable as to when he can retire. He's still sitting there with a ton of equity in the property, but now he could free up cash and that might move him to a closer retirement date. So it's not just for, you know, a non-high wealth applicant, right? Or it's not uniquely situated for that last resort applicant. It can be used as a financial tool for those that are sitting very well in advance of their retirement. So here's an example, okay? Let's say our youngest borrower was 74 and we had better interest rates than today at 5.5%, and the value of the home was 600. If you look over at the chart and you go to the age of 74 and you go to the expected rate of 5.5%, the principal factor limit, a principal limit factor comes in at 45.8. So that means on a value of 600,000, our loan, when we set this up, would be 274,800. Okay. All right. So how can you use this? Okay. Let's talk about your buckets of wealth. So from 18 to 62 years old, you've got that pre-retirement wallet. You've got your three buckets, right? You've got your monthly income. These are your wages, your commissions, your business earnings, pension and social security. Okay. This is your monthly income. Your nest egg is what you've been able to put away for retirement during that time. And maybe that's 5 to 20% that you've saved for your retirement, right? That's your supplemental income bucket. What have you put away for your nest egg so you can retire? And then your last bucket is the equity in your home, assuming you own the home right now, okay? It's your real estate equity. It's sitting there. It's just sitting there. Okay. It's not worth anything unless you sell your house. It's air. It's basically the air in your house, right? Yes, it has intrinsic value, but it has no monetary value monthly to you as you look to your retirement. So again, that your traditional spending, model basically says you're not going to touch that home equity. You're very proud you paid your home off. it's not working for you in any way, but it gives you that nice pat on the back, right? That you don't owe anything on the home. Well, maybe there's a better way to look at that house. You can use your reverse loan proceeds in numerous ways, okay? You can take a single disbursement lump sum. You can do fixed monthly advances. You can keep it as a line of credit, or you can do it as both. Okay, so there are fixed reverse mortgages that are available. You don't typically get as much money out on those, and the rates are higher. Or you can set it up as the HECM does, which is a line of credit, and draw down on it as needed, or set it up as a monthly stipend, or a combination of both. So, for example, when my mother took this out in 2008, she owned her home outright. She wanted funds to put a new roof on her home and on we had a freestanding two-car garage. She says, I want cash to do the roofing that I need. And I want to put a little in the bank, and then I want a monthly stipend. Well, from 2008 up until December of 2024, when we sold her home, she got that stipend every month, tax free. And when we sold her home, she still made a profit on the sale of that home. She's now 94 and very good health, but wasn't really able to keep up with that property at that age anymore. There was just too much that house needed for her to remain and stay there. So she's living with my sister, which is a good and a bad thing, I think, for my sister. But regardless, she's living with my sister and was able to walk away from the home and still have profit after, 16 years in that reverse mortgage, right? So, there's just a lot of nuancing to this that can work for a particular situation. The one important thing about the HECM reverse is that line of credit grows over time and will never reduce. Once it grows and the new limit is established, it stays there. So think about in years past when we've had devaluations in the real estate market and your second trust company calls you up and says, hey, you know that line of credit that you have at 100,000, we're stopping it. Okay. After this time, you're no longer going to be able to access it, or we're reducing it to 50,000 because of devaluations in the market. That can never happen on a HECM. As that line of credit grows over time, it can be used, paid down, and used again. And it will always remain at the higher levels and not decline. Okay. So you have greater borrowing capacity over time. It'll never be capped. It'll never be frozen. As I mentioned, due to any market conditions that could arise. That's completely different than any outstanding home equity lines you have now on your property. Okay. And it's liquid. It can be borrowed, used, and used again. Okay. So this just gives you kind of a graphic of how does that line of credit grow. So if you have a 62-year-old homeowner with a value at 600,000 and the available line of credit was at the time at age 62, 223,506, by the time that borrower was 27 years older at the age of 89, the estimated home value, and they typically assume about a 4% growth rate here, would be 1,024,132. But the equity line that they could tap into would remain at 1,026,643. So think about that. A lot could happen to your health in 27 years. Do you really want to deplete anything you have in your retirement funds to take care of higher monthly costs? The point here is there's a greater advantage of starting your reverse mortgage out at a younger age because of the way it can grow over time and have more access to equity when you may need it if your health fails, as you age. Okay. So that's the argument that Wade Pfau and other PhDs talk about in how you can use this, later on, and what the why of doing it sooner than later. Okay. You can use the home equity conversion mortgage to refinance your current mortgage and extinguish those principal and interest payments. You can use it as an available line of credit and on standby, right? You want to go buy a car and you don't want a monthly payment, right? You can access the line of credit. You can use it as a monthly stipend. For those of us that are commissioned, I have a realtor, and I always talk about this. I have a realtor who uses their reverse mortgage as a way to accommodate monthly budgeting because they never know from one year to the next how much they're going to earn. So they use the reverse mortgage all year, okay, up until November. And then they decide based on the commissions that they've earned if they want to make a principal payment against the reverse mortgage. Maybe they just have something in their head that they want to keep the balance to a certain amount, but they get the choice. Okay. And they make that decision. And I always say make that decision in November, because if you do make mortgage payments on that, you do want to get your tax statement for that year for your tax preparation, by the next April 15th, right? So you want to be sure that payment gets in and logged before the end of the year so you get the appropriate tax statement, right? So great for manipulating, changes or fluctuations in your earning potential, especially if you're commissioned. You can use it to close a retirement income gap. So for those of us that, as I mentioned, I'm turning 62. For my Social Security full benefit year, I would need to be 67. Okay, well, what if I don't want to wait till 67 to retire? you know I might want to use a reverse mortgage, but I want to wait till 67 to get the most out of Social Security. Let's say I could go on a reverse mortgage and use it as a monthly cash flow to make up that gap of what I'm not getting in Social Security, right? So, or to delay when I start taking Social Security. People have used it to, as I mentioned, to provide gifts to children, charitable organizations. Some people use it as a wealth multiplier where they're passing on a larger nest egg to their heirs. Okay. Um, Instead of waiting until they pass away to give gifts, they give gifts as they're aging, and they're trying to get perhaps their grandchildren or children investing sooner so that they can set up their nest eggs for the future. Use it to pay for, like I mentioned, cars, in-home care, big ticket expenses, home renovations that you need to make because you want to age in place. Long-term care insurance premiums, that's a huge expense as you age. So again, you can use the reverse mortgage for pretty much anything. You can use the reverse mortgage to pay the property taxes annually, right? You can use it for anything. So I just updated this, for an average cost of care based on the Genworth study from 2024. So home health care on average, this is across the United States, right? So for home health care, you've got them coming in the house. Maybe it's Alzheimer's care, meal prep, diet monitoring, errands, light housekeeping. Right now, the average is about 78,000 a year. Okay, it's a big number. If you move to assisted living facility, again, this is geographically based. It's going to be higher in the Washington metro area. But if you're looking at private apartments, on-site nursing, help with daily living and medication, that's about 71,000 a year to plan for. And then straight up nursing home care, if you want a private apartment, full-time in facility care, advanced long-term care, that's really over $10,000 a month for that type of care on average. Okay. So again, remember, Medicaid is only paying for shared rooms, and 95% of people have no long-term care insurance. And over 50% of the population will need it. Okay, so it's just something to think about, right? And how you can set yourself up now for expenses that might show up later. So again, for financial planning, it can help you keep your adjusted income low. And I always talk to financial planners about this. Think about it for a second. Let's say that your reverse mortgage has an interest rate right now of 7%, right? But your investments with your financial planner on average are earning you 12%, or more. You could take money out of your home and live on it and not pay tax on that money, right? It's 100% yours. There's no tax component to it. And you can keep your finances with your financial planner strategically earning you more than what you would be paying on your reverse. Okay. So you get to decide, right? You can work with your financial planner as to when's the best time for me to use those assets that when I pull them out, I will pay tax on them versus pulling it out of my property that I will not pay tax on, right? It's a great conversation to have because at the end of the day, whoever ends up with the most money wins, not the most equity, right? It's what you're leaving behind. Your kids are not going to care about your house, right? Whoever gets the most money in the end wins, right? Maybe they care about the house if it's a family home or whatever, and we'll address that. But the point I'm making here is you have to start looking at your house as just more than where you lay your head at night. It can be a strategic tool in how you want to grow your retirement funds in the future. It'll make those traditional retirement funds last longer because they sit in a place where they're earning more than what you're spending. It's a hedge against market risk. It may help ensure that you can meet those long-term care premiums, perhaps, and maybe it can maximize your other retirement contributions. Okay, so it's just kind of food for thought there. There was something I was going to say to that point. I'll come back to it. Okay. So why should you do this sooner than later? Okay. Well, there's a lot of statistics that prove why starting a reverse at a younger age versus later could be the best time. And I do want, since we're realtors on the call, I do want you to think about those downsizing or right sizing situations here. Okay. You get those clients that the house is just too much for them. They want to move to a smaller home. Maybe it's one level living, whatever it may be. And they talk to you about not having a mortgage and they talk to you about paying cash for the next property. I encourage you to, to mention this program to them using all of their cash assets. That way, if it's $1 million property they're moving to and they're going to spend $1 million in cash to get it, why not have a loan of 400,000? They're not making any payments, and that's 400,000 they get to keep invested somewhere else. Right? So, why 62 not 82 could be the best time? Well, Sachs and Sachs coordinated strategy says if you open this line of credit early, the odds of your cash flow surviving your age is 78%. You have a 78% cash flow survival rate. That assumes a 4% post-tax initial withdrawal rate based on 32 years of investment return. Okay. If it becomes the avenue of last resort, and you open the reverse mortgage. You delay opening it until you have spent every dime of your portfolio in order to live. Your cash flow survival rate drops from 78 to 60%. Okay, based on the same criteria. If you ignore your home equity altogether, okay, and you just work with your assets, your cash flow survival probability drops to 35% over that same 32-year period. Okay. Maybe 35% is enough. I don't know. But the numbers don't lie here in how you can hedge against running out of money in retirement. This is just a visual depiction of what I just discussed. So I'm not going to spend a lot of time on this one. But the HECM has the top consumer protections, right? The borrowers, because senior citizens are a protected class, they have to receive independent HUD counseling, not from me. It's from an independent HUD counselor that will schedule time, usually over the phone or via Zoom, with them to be sure they understand the pros and cons of the reverse mortgage. They will go over, there are some initial disbursement limits, as I mentioned before. In years past, people were taking out reverse mortgages, taking all the cash out that they could get with the reverse, not having any principal and interest payments, and then they were going into default because they stopped making their taxes and insurance payments and they walked away from the property. Okay, well, that can't happen anymore. There is a limit on how much the borrower can take out in the first 12 months of this line of credit. So for example, if the available line of credit that they were allowed to get was 200,000, they might be able to access 25,000 of that in the first year, and then the remaining, I'm not 25,000. Let's say it was 100,000. They might be able to access 25 to 30,000 of that in the first year, and then in month 13, the remaining 70,000 opens up and they could access the rest of it. So FHA wants to be sure taxes and insurance are getting paid on the property in that first year, and then they will open up the rest of the line of credit. We do a financial assessment to be sure that they meet the minimum family subsistence level for residual income, that they can buy groceries, that they can pay their taxes with whatever pensions that they make, and they have enough for minimum family subsistence on a monthly basis. FHA does offer a non-borrowing spouse protection, meaning you had a spouse that was not age 62 or older, so they're a non-borrowing spouse and their spouse passes away, they're worried that they're going to get kicked out of the house, right? Because they weren't on the loan. There is a stipulation in there that due and payable status for that loan could be deferred, right? Because they're a non-borrowing spouse and they want to remain in the property. Again, the line of credit is secure, it's unused, and it grows over time, regardless of what happens to the home value. Okay, that line of credit grows at the same rate as the mortgage grows over time. And again, that non-recourse feature, the house will always satisfy the loan regardless of the value of the home to the balance owed. As I mentioned, you can use this to purchase a property, right size your clients into their home based on interest rates and age of borrowers. That will determine how high the down payment has to be. And again, the goal here is to hang on to your cash and still not have a principal and interest payment, right? Think about the potential for the need for that cash as you age. Again, no principal and interest payments, must pay taxes, insurance, and any HOA or condo dues. We do offer, as I mentioned, proprietary reverse mortgages that are not FHA loans. They are conventional loans. They're typically designed for higher loan amounts in most cases, high property values, non-FHA approved condos. In most cases, the age requirements are 55 and up. They don't have mortgage insurance premiums, but they also don't afford the same protections, perhaps, or non-recourse features that the FHA line would afford. And you might not get as much on these, but they are out there. They are out there. We do see them often, like in California, really high value properties, type things there. But they are there, and we can certainly look them up for reverse mortgages. So what happens when the loan becomes due and payable? What happens? What's the trigger event where we would call that loan due, right? Well, you want to sell your home. Just like any other mortgage, the mortgage has to be paid off. No difference there, right? You want to sell your home, you can put it on the market, sell it, we pay off the reverse. If you decide to transfer title to somebody else, that loan is due and payable. Okay. When the last surviving borrower moves out of the property permanently, the loan is due and payable. Okay. I'm not talking about snowbirds here, where they go down to warm climates in the winter time and they want to spend some time with family and they're out of the house for 2 months or 3 months. That's not what we mean here. It's permanently vacating the property. If you default on the loan terms, meaning you do not keep your taxes and insurance up, okay, you're going to go into foreclosure just like you would on your current house if you fail to make the required payments and the last surviving borrower passes away, the loan is due and payable. Due and payable means payable within 30 days. Okay. The reverse mortgage, however, does have stipulations based on the situation and if there's heirs and if there's equity, where you can extend that out for 6 months to try to market the property or do what needs to be done. And then there is also one additional 6-month extension that may be granted. Okay. So it could be as much as 12 months in order to handle getting rid of the property. So how is the balance repaid? So let's say the loan is not yet due and payable. Just like any other loan, you can pay as much or as little against this loan as you want. You're not required to make principal and interest payments. So you have that choice every month. When a maturity event happens, like I just mentioned on the prior slide, that loan has to be satisfied, right? But the sale of the home will always satisfy the loan repayment, and the borrower or their heirs will never be liable for any balance deficiency. That is what non-recourse means. Okay, so again, as we talked about earlier, the value of the home is 400, you owe 450, you can just sign that mortgage over to the bank and walk away. No one has to do anything, and there's no tax implication to the heirs for that deficiency in value versus what's owed. Value versus what's owed on the property. But for the heirs who could be inheriting this property, let's look at the grid, right? We're going to ask these questions. First and foremost, do the heirs want to keep the home, and is there equity left? If the answer to that is yes, they can pay off or refinance the loan balance, right? That's one option. Or they can sell the home and pocket any profits, right? If there's no equity left in the property, but the heirs want to keep the property, right? So in our example, we had a property worth 400,000. They owed 450, right? So the appraised value came in at 400 and the heirs say, it's a family home, we want to keep it. They could buy that property for 95% of the 400,000. So remember, the balance on that loan is 450. 95% of 400 is 380. They could buy that home for 380 if they wanted to keep it in the family. Okay. If there's no equity left and the heirs don't want to keep the property, again, they just sign a deed in lieu of foreclosure and they walk away from the home. Okay. Any questions on that? So that's the protection that FHA affords that other reverse loans do not. And again, just why Fairway? This is a passion of ours at our company. All I'm going to say is we're one of the top lenders in reverse mortgages across the country. We have a completely dedicated team strictly to reverse lending. I'm licensed from New Jersey, Pennsylvania, all the way down to Florida and California, with the exception of Georgia. So all the East Coast states from Pennsylvania, Jersey on down, I hold licenses in and can do a reverse mortgage in those states as well as California. If it's a state that I'm not licensed in, I have a whole team and we'll find someone who could assist if they're looking for a reverse mortgage in a different state. Yeah. The likelihood of the debt being more than the value is low, though. What we're really talking about there, Greg, is what happens at the end in terms of, is the property not worth as if for some reason values of the property have declined or devalued, maybe the house itself has fallen into disrepair and the value on the mortgage is much higher than what you as a realtor could reasonably sell that house for, then you might see an upside down situation. But realistically, if properties were appreciating at even an average growth rate of 4% per year, you shouldn't run out of equity in the property. You know, you should still have equity in the property at the time that maturity event happens. Hope that helps. And that's all I have today. Were there any questions? I know
I don't know that answered Ginger's question. Hey, Ginger,
Oh,
that
I'm
answer
sorry.
did that answer your question?
Ginger.
Yeah.
Sorry, I thought it was Greg.
That's
Sorry.
because there's two G's
Two
together.
I know, I
GW,
saw that. I was
sorry.
like, there's two GWs.
Yeah, sorry.
Yeah, I know. Isn't that
No, it's fine.
crazy? It's very
It's fine.
confusing.
Go ahead,
Yeah.
Ginger.
I think I understand. I was just a little confused as to, I know appreciation, you're assuming 4%. I think right now it's actually less than that. It's probably about 2% they're saying, but
Mhm.
but the likelihood of that happening is low because of what typically appreciation is, right? Because you wouldn't go through.
It depends where you start. So
Yeah.
in my mother's example, let me give you an example. In my mother's example, when we set up the reverse mortgage, the actual loan amount, she wanted 35,000 in cash. By the time you factor in closing costs, because closing costs are higher on this because upfront mortgage insurance premium is 2% of the value of the home. And it's collected at closing. So you figure about in Virginia about 5% of the value of the home in closing costs. Okay, so it's an expensive program on closing costs, but there's no other program like this. All right. So in the case of my mom, when she first set up hers, she probably had about a $60,000 initial balance. Okay, on a property that was worth at that time about 325. At the end of 16 years, she was receiving about 1,400 a month as a stipend every month. Never accessed it for anything else. Okay. Just used it as 1,400 a month coming in over time. Well, you compound over time. Your balance goes up, it goes up, it goes up. And you keep compounding over time. At the end of 16 years, it grew to about 450,000 in loan balance that we paid off last December. Okay. And she still walked away with money when she sold the house. The property was valued, I want to say maybe at that time about 525, 530 at that time. It's a 100-year-old house. It needed a ton of work. You know what I mean? Another house like that, if it had done all of the repairs, would have been valued much higher. But nobody was putting, my sister and I were not putting money into a house that was 110 years old. And she was 93 at the time. She wasn't going to take care of the house as needed, and we can't keep doing it, right? So I think it's just a question of you need to think of your house differently. Like maybe you say, this is my throwaway house. Okay. If there's value in the end to my heirs, they can take it. They can sell it and they can get it. If there isn't any value, but I've put this pocket of money over here to provide to my heirs upon my death, wouldn't that have looked almost the same, right? Than if you had given them the equity, if they sold the house. It's just a different way of strategizing in your retirement. What do you want your retirement to feel and look like for you and your family? All right. If it's about keeping the house and the family, that's a different initiative. If it's about providing a certain amount of assets to the heirs, you can do it more strategically and perhaps lower your tax basis by pulling money out of your home that is not taxed versus pulling money out of your investments strategically that are. Or do a combination of both, right? Your financial planner is going to say, plan for 4% of your outstanding balance as your annual income. Okay. You have $1 million in assets. 4% of that is $40,000 a year, right? 40,000 divided by 12 is not much. But if you marry it up with Social Security and you marry it up with maybe 1,000 or two out of your reverse mortgage each month, what you're telling your financial planner is, I'm pulling out from that $1 million the gain I'm expecting you to make at a minimum on that $1 million that's going to continue to sit there and grow over time. I'm not expecting you to hit that principal. I'm expecting that $1 million principal to continue to grow over time, and I'm just going to take what it makes and live on that in conjunction with my Social Security or pension, and possibly use my reverse mortgage for those special things that I want to do instead. Right? So there's a lot, my whole point is people are living longer now. 62 is not old. We heard people objecting to the fact that at 55 they were getting AARP things, or at 50 they were getting AARP things. They don't want to be considered old or senior at 55, and they certainly don't at 62 either, because everybody's living longer, right? But I think the fact what I really try to get across with this presentation is just, your house is not just where you lay your head each night. It can be a real financial tool if you want to retire sooner than later. If you're thinking about what you're going to do with your home in your retirement, what do you want to leave your heirs ultimately? You could start planning for that now and accomplish it in a better or greater way with a reverse mortgage. Any other questions? I hope that helped clarify.
So I have a question. So remember 2008 where everything dropped,
Right.
How does that affect you on a reverse?
Again, the house will always satisfy it if it's this product.
Yeah, but you just won't get any more money out because now the
No,
value
they're
is way
not
down here.
stopping it. It will continue to grow. It doesn't matter.
Okay.
So
It's
if
hard
you're
for me to get my head
compounding,
wrapped around. Yeah.
yeah. So for example, if you're adding $600 to your mortgage balance because of an interest add this month, let's say your negative amortization went up $600. Well, guess what? Your equity line access went up $600 as well.
Wow.
It grows exactly at the same rate in access as it does in balance.
Okay.
Okay, so you're never going to have that go down. It doesn't matter. That's what you're paying mortgage insurance for. There's a minimum mortgage insurance monthly on this, plus a 2% upfront mortgage insurance on this. That's what you're paying for. That insurance fund is protecting that downside. at the end.
I want everybody to know that recently I had an insurance inspector come here because I had an insurance job that got done. He had to come and look at it. We got to talking about reverse mortgages, and this is what he said. All I can tell you is that you don't want to ever do one that isn't FHA, because you would not believe how much of a living hell it is for the people that have those loans, just based on what I see as somebody checking on the property.
Right.
They're not the same. And I thought that was very interesting. That's what he does all day, all week long. And he had an opinion about that. And I didn't even feed him any of that. He fed that all to me. And the second thing I want to say is I just recently got my Medicare stuff. And if you want to feel old, get that in the mail. That's non-negotiable, with a card that says, oh, starting in January, you get Medicare.
Yeah.
I just wanted to share that moment with you.
Well, and one other thing, just understand, you're all professionals. You've all worked with FHA in the past. So it's an FHA appraisal. And it may be 2 FHA appraisals that are required. There's no way we know up front if 1 or 2 are going to be required. It's an algorithm that gets run through FHA specifically that tells us this works or you need another one. Okay. So think of condition of the property. They're not going to close on a reverse loan if you've got holes in the roof. Those have to be repaired ahead of time. So that can impact whether or not you can get the reverse. They're not going to give you the money to do the repairs that you need because the house is not deemed to be safe for the borrower living in it now. So that can be, that can stop the process right there. I don't want you to go crazy with respect to the housing, but I do want you to think of safety and security when you're looking at a property for a reverse, that it has railings, on stairwells, right? It doesn't have peeling paint all around the windows. Is it older than 1978 with the lead-based paint notices, right? So just think about it from that standpoint. It's an FHA appraisal process. The roof is going to get looked at, everything is going to get looked at. And just kind of keep that in mind.
Okay. All right, everybody. Well, this was excellent as always. I mean, I've seen it so many times, but it's always one more thing I remember, There's a lot, because it's not like your typical. Yeah. Luckily, I just got a new roof and I'm getting new siding. So I will be all ready.
You're getting ready.
I am ready, except I can't do anything about all these animals.
Yeah,
you could vacuum 5 times a day. You know what I'm saying?
I do.
So they better like dirt.
Well, I want to thank everybody. We'll follow up with some slides to you of the presentation today. And if you have any questions at all, I'm happy to chat. So just feel free to reach out.
Thanks, Kelly. Thanks, everybody.
All right, have a good
day. Okay, bye.
Take care. Bye.